I think we'll have to, because your insights are very important. We'll have to split this into two two parts. So
Sure.
my question to you is, now once equity allocation is determined, the next question investors grapple with is structure with equities, structure within equities. Okay, so let me ask you this question. Within equities, how should capital be distributed between large caps, mid caps, and small caps today? In this, is this a cycle where quality cash flows and balance sheet strength should determine or should dominate over aggressive growth positioning? Over to you, sir.
Yeah, so see, we are never very pro, or we don't buy into using a particular style investing, like that. Okay, I'm a growth investor. I'll just invest in high growth companies, because there you end up the risk of investing in companies at very premium valuations. That is one. Plus, we have seen in last 20-25 years of data that companies which are growing at very high rate, they may not continue, they not be able to continue to grow at that high level, right? So while you have to pay premium for all high growth companies, let's say last 5 years,
Correct.
the company is growing at more than 20% annualized growth rate.
Yeah.
And we have seen that just 15, or rather 85% of such companies do not, or they are not able to maintain that kind of high growth.
Mhm.
In fact, their growth actually falls below the average growth of the economy, right?
Correct.
So you are in for that kind of a derating that happens in those companies when you are chasing only the growth, which is always exciting when it is, when it is the stocks are getting re-rated upwards because the company is putting good growth numbers.
Yeah.
But on the other side of the, when growth stumbles and the stock derates, you have double loss that happens to your portfolio. So it's very, you have to keep in mind that any particular style of investing where you say, okay, no, I only go with high quality companies with strong balance sheet and strong ROEs and efficiency ratios. There also, you have to see what is the growth outlook for these companies, what is the valuation that you are paying for that growth, and these are the challenges. So what we fundamentally like is your discount to intrinsic value approach. Okay. The scientific investing framework helps us focus on the specific, bottom up approach of identify each and every stock, see,
Correct.
establish the outlook for the growth, and then look at the valuation.
Mhm.
We extend the same framework when we look at the large, mid, and small cap universe, right? Now, traditionally, investors have been, allocating to these three buckets because it's easy. It's a simplified framework that one can look at.
Correct.
And yes, by the nature, larger cap companies are small, bigger, and they have diversified pool of revenue and so on. So they are less volatile, while smaller cap companies could be more volatile.
Absolutely.
And even because a lot of capital allocation starts, there's significant capital allocation that is happening on the large cap, and small cap companies may remain out of favor for a longer period of time. So the volatility is even higher, and with can happen at longer time horizons. So those are the challenges. But if you have a fundamental approach in terms of looking at each and every stock from a bottom up approach, then you will find that while small cap might be a more volatile at an index level, but it is such a large universe of more than 700, 800 companies,
Correct.
which can give you a lot of interesting opportunities, right?
Absolutely.
So that is why we are always excited about small cap and mid cap space, but we also continue to have large cap allocation in our portfolio nearly at all times, because always we have seen there is some kind of mispricing that continue to happen in the large cap space as well. So it's not our effort to construct a portfolio where we have some allocation to large cap and mid cap, small cap. We are looking at the full market from a scientific investing framework approach, doing a bottom up analysis, and we end up having significant allocation from all these three blocks.
Mhm.
uh, so that's one way. If you are building your portfolio ground up, then this is the approach you can have. But if not, if you are just a index investor or like a broad fund allocator, where the fund is kind of hugging the index, then you have to look at the index level valuations, right? And from that viewpoint, obviously today large caps look more attractive. While in the last 1.5 year, we have seen a time correction happening on the mid and small cap indices. So while there is still pockets of mispricing and in terms of overvaluation, and it is more concentrated towards the larger companies in the small cap, larger companies in the mid cap index. So there that is the challenge when you have a, kind of a passive route to your investing. But otherwise, I would say we are open, or we are allocating to all three segments, in a significant way.
Correct. Correct. So that is a very important nuance that you have just articulated, because market cap allocation often determines drawdown behavior. And moving from structure to leadership, let's now talk about sectors. On the sector leadership, this thing, where do you see durable sector leadership emerging over the next few years? Should investors build concentrated high conviction exposure or maintain broader diversification at this stage? What do you say?
Yeah, so see, diversification is absolutely important, and there is even at asset allocation level, or once you come to equities, also there also diversification is extremely important. We are, we don't believe in high conviction 5 to 7 stock portfolio, or the best, sector approach, or even the sector rotation approach. Rotation happens because there are certain sectors which become overvalued, and they are attracting more capital, and hence there are the capital moves out from some other sectors which become potentially undervalued. And then, in the next cycle, something which was undervalued outperforms, and this something which was overvalued underperforms. And this we have seen continuously. Even last 5 7 years, we have seen, companies like public sector enterprises which no one wanted to touch perform way better than the broader market, and companies which were the darlings in terms of, FMCG and other sectors, they have, really struggled to, kind of generate even the index level returns. So we like, certain sectors at certain times, but we don't marry them. Those sectors, we are okay to, and we don't hate either of the sector as well, right? So we are very conscious about, what is the growth outlook and what is the valuation that we are paying. Currently, when we look at the sector pie, we find, banking and financial services, specifically some fundamental NBFCs and housing finance companies at attractive valuations with reasonably high growth outlook for them.
Correct.
And on the back of the whole fundamental, way the Indian economy is transforming, which is heavy capex, heavy investments in infrastructure and manufacturing setups, and so on. So that is a space which is quite attractive. And again, the quality of balance sheet, the quality of businesses is continuously improving. So while one of events of, some kind of NPA or these things will continue to happen, so you need to diversify. You cannot chase that. Okay, this is the best bank, or this is the best financial services company that I want to buy. You have to continue to diversify even when you have identified a particular sector. So under the scientific investing framework, what we like is more of a growth vector approach. And we have, let's say, at least 5 to 7 growth vectors at all times in our flexi cap or diversified portfolio. And the idea is that it's two pronged, that once you have enough diversification, so whatever the outlook that you have for each growth vector, and if there are any risks that evolve as you invest, then you have various different growth vectors to support your portfolio. That is one angle. The second element of growth vector investing is that obviously you want to identify reasonably high growth companies at good allocation, good valuations. And there have to be external points or drivers to that growth, not only depending on just the management leadership or the management execution capability, which is obviously non-negotiable, which is now today in today's world is a hygiene factor, so to say. So management is expected to maintain and deliver consistently, very efficient operations. But beyond that, we look for areas which are getting transformed or have the potential to transform certain industries or certain offerings, so that they continue to have some kind of a broader growth for the economy, for that particular industry.
Correct.
And that is a very sweet spot when it comes to allocating for long term, right? So you are very comfortable that the growth trajectory is fine, the company fundamentals are strong, and then the valuation that you are paying is also reasonable. So you can, while the market gives goes through ups and downs, and they will all these events will impact the market, you are confidently investing in those various growth vectors.
Correct, correct, correct. Absolutely. So, so understood your point. So the balance between conviction and diversification must align with volatility, tolerance, and investment horizon. Now, beyond market structure, regulatory architecture also influences portfolio construction. So my fifth question to you, Ashwini ji, is with SEBI tightening scheme categorization, defining equity exposure, bonds in hybrid funds, and limiting portfolio overlaps, how should investors rethink fund selection and portfolio construction? uh, does this regulatory structure enhance discipline or reduce flexibility for active positioning? Over to you.
Yeah, I think frankly there is no dearth of investment options today. Okay, so the question of reducing flexibility is something I don't think is relevant. You have more than 1,000 companies to invest into. You have more than, I don't know, 3,000 funds.
Mhm.
You have thousands of AIFs and hundreds of portfolio management service and schemes, right?
Yeah.
So there are multiple options any which way. I think what SEBI is trying to do is, kind of simplify the fund selection, the allocation question for investors,
Mhm.
because it was anyway getting too complicated to identify the right fund for them,
Okay.
for the investors. So that way, as it is positive. I think it should be very very clearly laid out framework in terms of how various AMCs offer various investment products, and how investors can go about and select, right. But the fundamental aspect remains that whenever you are using any structure, whether it's a mutual fund or PMS, AIF, or any other global portfolio,
Mhm.
you are basically buying a set of companies. You're buying a portfolio, right? It's through different channels, it's through different routes,
Correct.
and the expected return from that is very fundamental question, right?
Mhm.
So we have always talked about this. The your expected return. You can have a fair idea about your expected return from a particular equity or any investment portfolio,
Mhm.
and the idea is to look at what is the yield you are getting, right?
Mhm.
Which could be and you can get an indication from what is the dividend yield. You can look at the PE ratio of the portfolio at a portfolio level, right? What
Correct.
is the price to earning ratio? Inverse it, you'll get E by P, which is earnings yield, right?
Mhm.
Which is not 100% distributable, but it gives you an idea that what is the kind of yield you are getting. So this is the first component of your return. The
Correct.
second component of your return is the growth of
Okay.
this, of the earnings of the company, or the free cash flow, to be precise. But that you will have to understand looking at what are the various sectors or
Mhm.
companies that the portfolio is exposed to, right? And if those sectors and industries are in for a good growth, then
Yeah.
you can build a intuition around how good at a portfolio level the earnings or the free cash flows of that particular portfolio is going to evolve over next 3 to 5 or the longer horizon. And then the third element is Are you buying it cheap or are you overpaying, right? So what is the chance of re-rating or de-rating, right? If
Correct.
you're buying a portfolio at 60, 70, 80 PE,
Mhm.
there's a good chance that either it remains same or it derates, right?
Correct. Correct.
Potentially.
Correct.
And while if you're buying a reasonably high growth portfolio but buying it cheap,
Correct.
then there is a high likelihood of re-rating, right?
Mm.
So while a lot of discussion will continue to evolve on, SEBI's classification, large, mid, small, thematic allocation, and so on. The tool that investors should always have handy with them is look at the P ratio, look at the growth outlook, and look at the re-rating or de-rating potential of these companies, and not just look at the past returns. Right? That's the mistake I've seen, that people really like to invest in something which is already going up. There's no harm, and it can continue to go up, but you should know that what are you paying for and how the future looks from this point rather than how the past is looking at.
Mm. Absolutely. Absolutely, sir. So, very well explained, and regulatory clarity can often strengthen structural discipline for long term investors. Let's now turn to valuation and liquidity dynamics. And the next question to you, sir, is markets today are balancing earnings visibility with global liquidity uncertainty. So, how should investors weigh valuation comfort versus growth momentum when deploying capital? Over to you, sir.
Yeah, again, see, we have to go back to the growth vector orientation here,
Mhm.
because first you have to establish that what is the kind of long-term growth that you are expecting for a particular sector, right?
Absolutely.
And then it becomes much easier to kind of think about the right valuation that you are getting for particular sector or portfolio, right?
Mhm.
And because you're right, you're basically essentially questioning the fact, the third component of the return which I said, which
Mhm.
is re-rating potential, right?
Correct, correct.
So if you are a believer that no, there is no re-rating that happens, or the only thing, my returns are guided by the earnings growth, right?
Mhm.
If you think that market is always fairly priced and it's just the earnings growth that is going to come to me,
Mhm.
whether the stock is at 80 PE or it is at 20 PE, it is fairly priced. And
Correct.
if the company is growing at 12%, 15%, 18%, then this is the return that I'm going to get. Then obviously the whole focus shifts to focusing and looking at the near-term earnings growth, right?
Correct.
Which is fine for a lot of investors,
Mhm.
and that can give you a clue towards the long term, because long term is anyway uncertain. So
Mhm.
the one way of understanding that closely is to look at what is how the things are evolving in the near term, in the next 2 quarter, 3 quarter,
Mhm.
4 quarter. But if you have the growth vector orientation first, right, you have a longer term horizon in terms of understanding the growth prospect, and then you recalibrate your understanding based on every quarter earnings, right?
Yeah.
That is a metric that we like more, rather than just focusing on the near term earning outlook and then trying to, kind of position your bets on that. Because what happens in that case, that you miss out on, if there was a bad quarter, the last few quarters were bad, and then suddenly you see, let's say, 30-40% earning growth,
Mhm.
and then you really become excited, but that's just a pent up demand playing out,
Mhm.
or something kind of very very temporary phenomena, and you start allocating heavily, then you will be in a, there will be a shock in terms of, how it plays out over the next 2-3 years.
Correct.
But if you remain focused in terms of long term growth vector, and continue use the near term earnings to just to recalibrate your hypothesis,
Mhm.
then that's the right approach as per, the way we look at the portfolios.
Correct. So that's a powerful point, sir. Valuation discipline becomes especially critical in late cycle optimism, and which leads us to naturally to risk architecture.